let's start because we have 5 minutes past 7. So last we stopped was on sanctions, right? Sanctions we didn't start off. Is that correct? Anyone who recall? Hello? Hello, can you hear me?
Yes, I can hear.
Can hear, right? Okay,
Yeah.
so we are going to start off with sanctions. And so anyone who'd like to go at what sanctions are and possibly few examples of sanctions before we look at what's in the text? I guess no answer. So I'll basically explain what sanctions are. Sanctions are actually policy tools that national governments as well as multilateral organizations such as UN, EU, and even countries such as US take to constrain any perceived threat to security or any criminal activity that they deem illegal, right? So it's a measure of enforcing sufficient pressure on either a country, individual, or a particular activity, right? So in the most recent case, you have heard about the Russian sanctions, and most countries like US, EU, UK, Canada have imposed sanctions on Russia as a result of Russia invading the Ukraine and as a result of the impact it has not only on Ukraine, but from a global perspective. So basically, when you have financial sanctions, you cannot deal with that particular country and or an individual, right? So in the case of Russia, most government authorities, government-owned banks are sanctioned, and as a result of it, the financial flow of those banks are heavily being restricted, right? So basically, it's financial sanctions, that laws that restrict prohibited dealings with countries, companies, and individuals, right? So who are the countries that can impose sanctions? Like for an example, the US, the European Union, or any multilateral organization such as the UN. So also, what are the usual type of targets? Usual type of targets could be terrorists, narcotic dealers, government officials, anyone who is dealing with weapons of mass destruction. So in that light, do you know from a US or an OFAC perspective, what are the countries that are sanctioned?
North Korea.
Yeah, that's correct, right? North Korea. What else?
China.
China, Iran is correct.
Syria.
Syria. So Iran, Syria, North Korea, and Cuba also has OFAC sanctions, right? So China does not have OFAC sanctions. And if you look at the UN, UN also impose economic sanctions against countries, individuals, or groups. Their main objective is to preserve peace, prevent nuclear proliferation, and also they use sanctions as a way of combating terrorism, right? So if you look at terrorist organizations like Al-Qaeda, all that, there's some list called the United Nations Sanctions consolidated list, right? So it's called the UNSC list. And if you are a designated party in the UNSC list, your access to financial systems are going to be significantly limited, because as a sanctioned party, banks will screen against this sanctions list to ensure that you do not have access to the financial system in a legitimate way, right? So then sanctions also could be, now in the case of US sanctions, US look at sanctions either from a country perspective or a list perspective, right? So list-based sanctions or a country-based sanctions, right? Um, so sanctions checking from a textbook perspective, what does it say? Where an individual company, organization, or even country is considered to have an acted illegally, it is possible the rest of the global community to take actions against the abuse. One mechanism by which such action be taken is financial sanctions. Financial sanctions prevent the use of movement of monies relating to certain individuals or organizations considered by the international community to be unfit. In this way, those committing illegal action should not be able to benefit financially. And one way of blocking the finances is making sure that they have no access to sometimes trade products. So export restrictions are there, trade related sanctions are there, and also certain countries that deal with sanctioned countries also will result in getting sanctioned as well, right? So sometimes we often look at Russia as a mechanism of getting oil, and that sort of exposes us to a situation where we are dealing with Russia when the rest of the world is imposing sanctions on Russia. So just for an example, right? So then moving on to the theory, organizations such as UN maintain sanctions lists, which is what we just discussed, and financial services firms should seek to minimize the risk that they are servicing any customer that are subject to financial sanctions. So anyone from banks, can you let me know how does banks know whether they are banking anyone who is in the sanctions list?
Through transaction monitoring.
Okay. Anyone else?
KYC clearance at the time of getting into a relationship.
Yes, right. So that's correct. So KYC clearance usually has a sanction screening. So most banks at the time of onboarding, they will do a check against a sanctions list to see if a particular individual that is subject to be onboarded is in the sanctions list or not. That's one check. So is it sufficient just to do a one-off check at the time of onboarding and not do subsequently, or should you do subsequently as well?
Subsequent checks are also happening.
Subsequent checks are also required, right? So it's not an ongoing. So most institutions will have a mechanism that is automated, right? We cannot manually check against a sanctions list and compare that against a database. So there are sanction screening tools commonly used, and financial institutions would be using one of these common tools in order to screen against a sanctions list, right? So in addition to, of course, the financial penalties that an organization or a bank may be subject to for dealing with a sanctioned party, it will also significantly impact their reputation. So if it's in the case of a global organization, it will be even more significant for dealing with the sanctioned party and the reputational impact and the loss of business it may result in as a result of that reputational damage. So that's why it's really important for banks and organizations in general as well to ensure that you have robust mechanisms and controls to identify, and also if in case identified, not to onboard and ensure that you are compliant with the sanctions regulation. So moving on to the next slide. Give me a second. Did the slide move? Hello?
Yes.
Yeah. So the international framework for financial sanctions do not prescribe the process which firms have to adopt. Basically, it says that you need to make sure that you don't bank these individuals. They won't specify how exactly you should comply with, right? Firms should have a process to manage the risk conducting business with on behalf of individual entities and a list provided by the government or directly from the UN and other appropriate sanctions lists. So in Sri Lanka, we ratify against the UNSC list, and anything that gets added on to the UNSC list, we, from a local regulatory perspective, we are expected to comply with. So when you look at sanctions, you look at it from two components. One is from a customer perspective, whether your bank will onboard or maintain a relationship with a sanctions individual or a sanctions entity. So that's from a customer perspective. The other aspect is whether your bank will transact with a sanctions entity or a sanctions individual, right? So when you look at sanctions, you have customer screening as well as transaction screening, which is performed on an ongoing basis. So we discussed many firms use automated screening software provided by a commercial provider, and firms, even though the textbook says other firms rely on manual screening, in reality, most organizations are now on automated screenings. Firms may consider what type of screening software to use in line with their nature, size, risk profile of their business. Any automated screening should meet the business requirements, and firms should also understand the capability of such system. What's really critical is to ensure that the sanction screening system has a fuzzy logic, which means when you identify a name, even if the name is partially there, it should indicate as a potential match, especially in the context of Sri Lanka, where Sri Lankans will have very long names. Sometimes certain entire names may not get captured into the full the banking systems that the banks use, right? So it's important that whatever is getting captured and what is getting screened need not be identical. Even a fuzzy match could result in a potential alert, which can then be subject to a review by the respective compliance officers and then determine whether this is an actual hit or a false positive. So moving on, the scope and complexity will actually be determined by the firm and the nature of the business activity. So if you look at an effective screening process, it should have few elements. Firstly, it should flag up potential name matches against a consolidated list. So in the case of Sri Lanka, it's important that your screening tool has a mechanism to screen against the UNSC list. And names again which measures have been issued. For example, in the UK, under the Counter-Terrorism Act. So in the UK sanctions are issued under the Counter-Terrorism Act. Potential matches should be reviewed by appropriate trained staff. So usually when an alert is generated, that alert goes into a specialized team, and that team then will review the alert and determine if there is a potential match. If that team can't determine, they might reach out to the branch or the relationship manager to further clarify if there are any clarifications required. Where matches are confirmed as true matches, appropriate action should be taken to freeze accounts. And of course, depending on the nature of the potential match, there might be reporting also required to the respective parties that who have imposed sanctions. True matches should be reported as soon as practically possible to the relevant law enforcement agencies or government department. The firm should maintain an audit trail of actions around potential true matches and the action it has taken. And also not only the true matches, firm should also maintain documentation of any discounting of potential matches which are considered as false positive. So there should be a good balance between the number of false positives generated, right? For an example, the generation and resolution of an undue number of false positive may have a negative impact on the efficacy of the resolution process, because if you're entirely, so then your sanctions screening fuzzy logic may need a little bit of tuning to ensure that it gives results in a reasonable way, um, appropriate to the numbers that you wish to manage. Moving on to the next section. All customers should be screened during establishment of the business relationship. We spoke about it. Firm must apply enhanced due diligence measures on risk-sensitive basis in situation which its nature can present a higher risk for money laundering or terrorist financing. So usually, in the case of entities, the exposure could be that the entity is sanctioned or entity is dealing with a country that is sanctioned, so entity is dealing with another entity that is sanctions, which is a part of their supply chain, right? So that level of screening is required and expected by banks, and banks will usually ask questions from entities to understand which countries do they deal with, uh, what are the countries that their top revenue is being generated from, in the case of an exporter, for an example. Then they will also understand the top 5 buyers, the suppliers, and determine if any of those buyers and suppliers have been sanctioned, right? To provide a basis, so as a part of the risk-based approach, therefore, firms may need to hold sufficient information about the circumstances and business of their customers for two principal reasons. One is to inform their risk assessment process and thus manage money laundering and terrorist financing as well as sanctions risks effectively. Then the other is to provide basis for monitoring customer activity and transactions. So at the time of onboarding, if you do identify a particular customer, either an individual customer or an entity, particularly as a higher risk in terms of money laundering, terrorist financing, or from a sanctions perspective, you may consider that customer as a high risk customer, and you may have more frequent reviews being conducted on that customer. Now, how can a particular customer be a high risk customer? It could be based on the nature of the business. So different organizations will use different criteria, but effectively, what an organization will look at is how vulnerable is that country, is that entity's business model to financial crime. And that's effectively what they're looking at. Either it's in the nature of the business model, either it's in the nature of the countries that they operate in, or the parties that they deal with, or it could be just the nature of the business, which could be cash intensive business, and that could also result in um, them being considered as a high risk customer. So why it's important is to demonstrate that there is a process in place and also to ensure that the appropriate reviews are being conducted on an ongoing basis. Okay, I'll pause there. Any questions?
So for a non-financial organization which is having a let's say a multinational organization which is head office based in UK, how does that applies in a local context? You know, what are the requirements that they need to meet?
So for an example, if your group head office is in UK, then sanctions does not necessarily apply only to organizations or only to financial institutions, right? Sanctions applies across entities, right? So if your head office is in UK and then you are bound to be guided by the laws of the UK financial sanctions, right? So any organization will be subject to that, and there should be some. So for an example, if the subsidiary is dealing with a sanctioned party, and by virtue of that being a subsidiary which is fully owned by a group office which is based and incorporated in UK, then that will expose them to sanctions risk, right? So that's why especially global organizations who are subject to multiple regulatory frameworks should have more controls or better controls in terms of managing their sanctions exposure overall. Okay, thanks for the question. And so I'll ask a question now. If a particular person is sanctioned, can you, under any circumstance, transact with that person or an entity? So the only way that they can transact is usually when a sanction is imposed, there is a general winding down period. So there is something called a general license being issued very specifically for a short time period. Then also for humanitarian basis. Now, let's say for an example, you want to send humanitarian aid to Syria. And if you can demonstrate that, you can apply for a very specific license for that specific transaction, as long as you can demonstrate it is for humanitarian aid. So those are very specific approval processes and specific requirements that you'll have to fulfill in order to effect that transaction. So that those are the only circumstances. So let me move on. So we spoke about OFAC. OFAC is actually a part of the US Department of Treasury, and any US sanction usually comes through OFAC and acts under the Presidential National Emergency Powers as well as authority granted to it by specific legislation. OFAC has the right to impose controls on transactions to freeze assets under the US law. So then we spoke about the UNSC, and for OFAC, OFAC is responsible for the administration of the specially designated national list, right? So SDN list, which contains individual and organizations. With so there's a UNSC list and also an SDN list from OFAC, right? So the other thing is sanctions are the last resort imposed in variety of instances, including combating terrorism financing, proliferation financing. All right, so we spoke about these two entities. So moving on to the next topic, which is politically exposed persons. So why is politically exposed persons require, why do we speak about them in the context of financial crime?
Because they are influential.
Yes, because they are influential. I'm still looking for something, some specific word.
Money laundering activities, there could be links.
There could be links.
Maybe they have more protection than a general person when it comes to an illegal activity due to their connections.
Could be. And the other aspect is the fact that they have access to public funds, right? So if you look at a part of financial crime is corruption and bribery, right? So the fact that they have access to public funds exposes them to more financial crime from a corruption and from a bribery point of view, especially on a corruption point of view, right? So now I know for a fact that the Transparency International in Sri Lanka, which is actually a global body that is fighting against bribery and corruption. And Transparency International actually a couple of years back introduced a PEP list. So basically anyone who has a political affiliation were included in that list, and local banks now actually can look at that list. I don't know whether there's automated screening which is possible against that list, but local banks can actually review that list and ensure that that whether the individual that you're onboarding is a political exposed person. So usually you don't discriminate anyone as a result of their PEP status, right? So PEP status itself does not incriminate individuals or entities. It does, however, put the customer or the beneficial owner into a higher risk category, because PEP customers should definitely be the ones that in your high risk category of clients, right? So they need to be subject to more rigorous reviews. And also at the time of onboarding, they need to have additional due diligence completed, right? So if you are looking at standard due diligence and enhanced due diligence, PEP individual need to be subject to enhanced due diligence. So the question is, if you are in general, right? In general, if you are onboarding a politician into your organization, would you clarify if there's an asset declaration that is being completed, and if the funds that are coming into the account is in line with the assets that has been declared, right? So those are the questions that you need to ask. And then the other is, what's the purpose of the account and what are the transactions that are expected to flow through the account? And usually when you know what are the transactions that should flow through the account, any unusual transaction that comes through the account should actually get flagged as a transaction monitoring alert. And then that alert needs to be reviewed by specialist trained staff for investigations, right? So looking at literally the definition, PEPs are individuals who have a high political profile, who hold a public office. Such persons can impose a higher money laundering risk to the firms, as their position may make them more vulnerable to corruption because of the accessibility to public funds, because of the influential positions they hold and the decisions that they can make, which can actually benefit them unduly, right? This risk also extends to members of its immediate family members. And so why is immediate family members or close associates? So why are they considered FEPs?
It can be used as a channel.
Yeah, most often than not, all the politicians' accounts are quite clear because they are coming under significant scrutiny, right? So usually you do not directly transact. And look, it could be in various forms, right? It could be that you're entering into a contract and that contract doesn't go through a tender process, right? Why? Because you want to give it to someone that will in return give you a favor as a result of giving that contract, and that funds then directly cannot come to the politically exposed person. that funds will be routed through multiple channels, multiple countries. But usually what happens is investigation teams should be able to map these transactions. So then I spoke about the PEP status does not incriminate or individuals or entities. It's just that you need to have enhanced due diligence, right? So from a definition point of view, PEP is an individual who is or has at any time in the preceding year been entrusted with prominent public functions and an immediate family member or known close associate of such a person. So moving on, close associates are also natural persons who are known to have joint beneficial ownership of legal entities or legal arrangements, or any other close business relationships with PEPs. Natural persons who have sole beneficial ownership of legal entity and legal arrangement, which is known to have been set up for the de facto benefit of the PEP. So these are definitions coming in from UK. In a Sri Lankan context, if you're working in a bank, you should also use your local knowledge and judgment, right? There may be local knowledge and awareness of a particular close associate of a politician, and that's publicly available news. And if that close associate comes to you to open an account, then it might not necessarily fall into this specified definition in the textbook, but then still you need to use your judgment and consider them as close associates of the politically exposed persons and use judgment to ensure that they are tagged as PEP. So EU Directive 2006-70 EC sets out the implementing measures for defining PEPs and also provides definition of positions that constitute prominent public functions. So usually from a regulatory perspective, the regulation should define what are the positions. From a regulatory perspective, there's a PEP related regulation issued, and in Sri Lanka, that definition of, if I recall correctly, that definition is quite broad and extensive. And so in terms of, at least from a regulatory point of view, we have a very good detailed regulation with clear expectations being stated, right? So heads of states, heads of government, ministers, deputy and assistant ministers, member of parliament, member of Supreme Court, member of courts, auditors, ambassadors, members of administrative management and supervisory boards of state-owned enterprises, right? So in general, these would be common across countries. So firms are required to take a risk-based approach to PEPs. So any financial crime and the process that you intend to mitigate the financial crime is generally risk-based, because you do not have ample resources to make sure that you do 100% check in all instances, right? So again, have appropriate risk-based procedures to determine whether the customer is a PEP. So you need to have an internal policy. There is a regulation that is there relevant to the country, and from an individual bank point of view, you need to have a PEP policy in place in terms of defining what PEP categories are, and also defining what the risk-based procedures are. Obtaining appropriate senior management approval for establishing business relationships. So there is a higher level of approval required to onboarding a PEP. Take adequate measures to establish source of wealth and source of funds. So this is really critical. Why is it critical? It's just not a matter of asking the customer what's your source of wealth, source of funds. That needs to be validated with some form of documentation. More often than not, people use inheritance as a criteria of defining wealth. If it's inheritance, there's still a way of proving that you've inherited some funds through family, right? Conduct enhance ongoing monitoring of business relationships. So we spoke about at the onboarding as well as ongoing due diligence. So usually politically exposed persons, how frequently do they get reviewed in your banks? Anyone? So usually as a general standard, within a 12-month timeline, you need to review a politically exposed person. Moving on to, so now we are going to look at the controls required by a firm to manage financial crime risk. So risk can actually arise from clients, products, or delivery channels. If you look at the clients, what is the risk posed by firms' customers? So does the client satisfy the definition of a PEP? One example. And does he require additional enhanced monitoring or enhanced due diligence? Customer is based or conducting business through a high-risk jurisdiction. So if the customer is an entity and if they have dealings with high-risk jurisdictions. So how do we identify high-risk jurisdictions? High-risk jurisdictions could one way be countries that are sanctioned. Then it's extremely high risk. Then it could also be that they are dealing with countries that have low tax transparency. Countries like British Virgin Islands, Panama, for an example. It could also be countries that are grey listed in the FATF, which or from a UK perspective, that are included in the high risk third country list. So which Sri Lanka was actually a few years back, and so that's one mechanism. So the other is the customer own business within a sector that places them at higher risk of exposure to financial crime or corruption. So if an entity is dealing with the government more closely, does the entity themselves have a good policy to avoid bribery and corruption? Does the entity themselves have controls to avoid? A firm would not want to be associated with a customer who could be exposed as committing or facilitating financial crime, both from a public relationship perspective as well as practical implication of dirty money being found to have passed through firm's financial product or market transactions. So then next we're looking at what is the risk posed by customers' behavior. So has the firm established relevant controls over dealing patterns and trends to identify whether a customer is performing unusual deals could be suspicious? For an example, at the time of you onboarding, usually an account opening form will ask for your occupation. And if that occupation says you're employed, usually your pattern of transaction should be your salary comes in, then you have multiple withdrawals, transfers, utility payments, etc. So that's just a general profile. Now, if you're employed and your salary comes in and you have multiple other third-party deposits coming into your account, now that is an unusual scenario, right? Now, in the case of people who collect money on behalf of people who give money on interest, right? So they collect funds back. People even who have certain pyramid schemes, certain Ponzi schemes may be collecting funds. Then also business transactions can be routed through a personal account. And that is also an unusual transaction because business transactions should be routed through a business account. And the customer could actually be evading taxes as a result of routing it through the personal account. So those are considered as unusual behavior. How would the firm react if a customer asks question about the level of secrecy regarding the transaction? So if you see a customer coming to a counter and trying to understand what controls an organization has and trying to circumvent that control, asking what thresholds are used for monitoring transactions, usually is in a hurry at the counter, wants something done immediately, just will refer that they know so and so, and we need this done immediately. So those are all unusual behavior, right? If the customer is not a private individual, is the operator of the account willing to provide relevant information about underlying owners and controllers? What risk is posed by way of customer became a customer? Now, for an example, was the firm able to complete necessary due diligence? Or did the firm miss certain documentation? Where the customer came to the firm via financial intermediary, is the firm confident in the due diligence material provided by the intermediary? Usually in an onboarding process, documents via intermediary may need to get notarized by a lawyer. In certain jurisdictions, it is required, and maybe if it's an entity, a company secretary at least at a minimum, right? So was the customer accepted after distance communication, or was it a face-to-face onboarding? Now this is quite relevant because organizations working on hybrid mode may end up trying to conduct due diligence non face-to-face. Now in Sri Lanka also there was a guideline issued, I think in October 2020, if I recall correct, where you can actually onboard non face-to-face, but there are certain controls that is required. So in certain instances, in advanced countries, you can actually use facial recognition tools at the time of onboarding, and algorithms to understand if actually the person is on the other end is the same person that you're opening the account for. So moving on, if you look at products and services, does the product allow third-party payments? Now, if any product is allowing third-party payments, and that product is generally exposes you to more financial crime risk, right? Could the product be used to enable inappropriate asset to pass through the firm? Does the product include other features that could enable money laundering or terrorist financing? Then, so understanding the controls to manage and mitigate money laundering and terrorist financing. Controls could be measured to verify the customer's identity. So identification and verification of the customer, collect additional information about the customer where required, conduct enhanced due diligence, having procedures in place. It could be having trained staff at the counters, or having trained staff, say, having trained relationship managers. Then it could be having a robust control mechanism to screen transactions, screen customers, then monitoring transactions and unusual activity, a robust way of reporting such unusual activity to the respective authorities. So that's all the controls that you should have as a part of managing financial crime risk, right? Part of the control framework will evolve decisions as to whether verification should take place electronically, and that's what we just discussed. And to the extent the firm can use customer verification procedures to carry out by other firms. So usually the KYC process is not outsourced, but the systems used for the process may not necessarily be built in-house. To decide on the most appropriate and relevant control for the firm, senior management should ask themselves what measures the firm can adopt and to what extent to mitigate these threats. Risk most cost effectively and in line with the firm's risk appetite. So examples of controls include introducing a customer identification program, which we spoke about, requiring the quality of evidence documentary. So again, in terms of KYC documents at the time of onboarding needs to be stored, and it needs to be retained in most instances, even after the closure of an account up to a specified period of time. Usually, sometimes it's 5 years, and that is being kept by organizations. Obtaining additional customer information, we spoke about if there is higher risk of financial crime, and then monitoring customer activity and transaction. We spoke also risk management is not a one-off process. It's a dynamic and a continuous process, and it's not a one-time exercise, and regular reviews are required. So next we'll speak about training. So training is also a very important control in fighting financial crime. Why is that? Because no matter what system you use, there is an element of judgment that individuals will have to make to avoid financial crime, right? So systems can only detect to a certain extent, but systems may not entirely be a fully fledged solution, right? So therefore, it is important that you have a very good training program relating to financial crime management. This training program also could identify certain high-risk roles and conduct more in-depth training. These training programs could also clearly articulate what are the escalations channels you have, and what are the places to get support from, what are the parties to contact to get additional support from, right? So let's have a quick look at what the textbooks say. So it is essential that the firm train employees in respect to fraud, money laundering controls, and the prevention of terrorist financing in order to staff to be able to recognize suspicious event and will know how to escalate any suspicion. So training is important from an escalation point of view, because if you identify unusual activity that needs to get reported to a specific investigation team, which usually is headed by the money laundering reporting officer. And then if that investigation determines that this transaction that was unusual is now actually a suspicious transaction, then that suspicious transaction gets reported to the respective law enforcement agency. Once it goes to the law enforcement agency, then what they will do is they usually will look at an industry-wide view of what an individual financial institution have submitted, and they will be in a position to connect the dots in a more efficient way than what an individual financial institution may see. So key criteria for training program includes understanding the internal controls, staff responsibilities under the firm's arrangement, obtaining sufficient evidence of identity, recognizing and reporting knowledge of suspicion of money laundering, potential effect on firm, its employees and employees personally, and on its clients of any breach of law. The content and frequency of trainings reflect the risk assessment and the products and services that their organization offer. Appropriate assessment at the end of training to ensure that the training is effective, and usually training records needs to be kept to ensure that you demonstrate to either internal audit or an external regulatory review that may happen at some point to demonstrate that you have conducted effective training to the respective staff. So we spoke about this slide already. Spoke about selected related employees should be given appropriate training to identify fraudulent activities, criminal law relating to money laundering, and regulation guidance issued by the regulator, right? Staff will find it helpful to have illustrations of the type of situation that may be unusual and which in certain circumstances might give rise to reasonable grounds for suspicion. So it's important, especially for branch staff, when there is high turnover, that senior staff will educate the staff that are joining in and also the staff joining in if found suspicion that they have a channel for escalation. So I think we've come to a final section. So effective suspicious activity or transaction reporting, right? So all staff must raise an internal report where they have knowledge of suspicion. And it's not the individual staff's responsibility to decide whether this needs to go to the law enforcement agency. It is the responsibility of the money laundering reporting officer. Staff's responsibility is to escalate it to the respective investigations team. And then money laundering reporting officer's responsibility is to decide whether it's suspicious, and then it needs to be reported to the respective law enforcement agencies. Firm's nominated officer must consider all internal reports, which means anything that is coming through internal sources either needs to be reviewed and then be discounted as it's not as suspicious. Even if you discount, such discounting records needs to be kept and should be able to submit at a future point in time. Firm's nominated officer must take external report to the relevant LEA as soon as practical if they consider that there is knowledge, suspicion, and reasonable grounds of suspicion. The firm must seek consent from LEA before proceeding with suspicion transaction or entering into arrangements. Firm must freeze funds if customer is identified as being on the sanctions list on the government website or suspected terrorists or sanctions individual the entities make an external report to. So usually when a suspicious activity or suspicious transaction is being reported to the regulator, organizations or banks should make sure that you do not inform the respective customer. So that is actually considered as a tipping off offense. And tipping off offense means that if you do tip off, now if you are reporting a suspicion, and then you inform the customer of reporting that suspicion, customer can immediately take action and withdraw funds from other financial institutions, and it will stop or it will hamper the investigation that is being conducted by the law enforcement agency. So in the case of Sri Lanka, it's a financial intelligence unit, and then financial intelligence unit usually after the investigation may pass on the files to either CID for further action as required. But honestly, in Sri Lanka, money laundering related prosecutions have been very limited. I guess it's in single digit numbers, and that's where even from FATF perspective, enforcement action taken always comes under a lot of scrutiny. Not only unique to Sri Lanka, I guess even where I'm speaking to you from Philippines also, the enforcement action was called out as an area for improvement. So firms need to ensure detailed records are maintained. We spoke about that. Details of any disclosure made regarding the inquiries, reason why suspicious activity or suspicious transaction was not submitted. So that is also critical. We spoke about it. Any communication made with or received from authorities. So once you submit a suspicious activity, the authorities may ask you multiple questions, clarifications, information, more details. You're bound to provide that as early as possible. Where relevant details of need for prior consent to be received from LEA before releasing the proceed of transactions, together with details of any such consent received. So usually once the law enforcement investigation is completed, they might freeze the funds in the account and you may get a freeze order from the respective authority. So we spoke about tipping off as well. The last point is normally a criminal offense for anyone following a disclosure to nominate officer or LEA to do or say anything that might either tip off another person that disclosure has been made, which may prejudice an investigation. So we spoke about that as well. All right. So we have now come to the end of the session. So that's all the theory that I have. And for the remainder of the session, I have a question and answer slide. So I'll move on directly. So rather than taking a break in between, I'll directly go on to the question and questions, and then we will probably finish off within the next hour maximum. Okay, so if you will get these slides tomorrow. Himali will share the slides, and for anyone who have had the opportunity to look at the textbook and also compare some of the slides, some of the slides are identical. I've done it intentionally rather than giving a summary. I've given most of the text from the slide so that it will help you from a revision point of view. All right. Any questions before we move on to the questions?
Hi, Shen, I have a question.
Hello.
Yeah, I have a question. In a case where, let's say, one of our clients are getting funds from a PEP, and it's a one-off transaction. In that case, what do we do?
So if your client now, if for an example, I'm assuming that you're from a bank, so your client is an individual client or an entity client?
Individual client.
Yeah. So individual client, what is the purpose of getting funds from a PEP?
I think because it's probably for investment purposes. If I'm not mistaken.
Yeah. So what is so it's not something that we can answer directly, right? So I'll tell you a few ways of looking at it. Just understand what your client is doing and what is the connection with the PEP, right? So if your client is a teacher, I'm just hypothetically creating this profile, right? If your client is a teacher, then why would a PEP transfer funds for investment to a teacher? So that is not plausible, right? Either way, if you look at funds being transferred into an account for investment purposes, why would a PEP transfer funds to a third party for investment purposes? I would consider that as a close associate, right? So it appears to me that this PEP and this customer has a close association. So the only way you can feel comfortable is by asking a lot of questions, right? Understanding the bottom of the transaction and the specific purpose. Investment is too broad, right? So investment, some may say, no, I'm getting some commissions. So some might say I have, I'm getting some commissions from consultancy. So that in itself, okay, fine, you're getting commissions from consultancy. Is not plausible. You need to understand, okay, what is the consultancy? Does that consultancy match with your expertise? Then do you have a contract for consultancy? If so, can we have the consultancy contract so that we know that the funds that you're receiving from this particular party is actually in a document already for the services that you provide, right? So those are the questions you need to ask. For me, based on what you have said, funds coming from a PEP to an individual and investment purposes, that to me sounds a little suspicious unless I ask a lot of questions and understand what the real purpose is. I hope I answered the question.
Yes, Shen, and also the client is a hedge fund owner. Person is getting money.
Okay, so client is an entity. So client can, so it's still going into a personal account, right?
Yes, it's going to a personal account.
So that why would it go into a personal account? Now it's plausible, right? Your investment story and going into a hedge fund owner is plausible. But then the question is, why is it going into a personal account, right?
This could be a potential personal account used for
Business transaction, right?
yeah.
So that then someone is trying to evade taxes and legitimate ways of investing. So anyways, now when you say it's a hedge fund owner, at least the transaction is legitimate, right?
So there won't be any money laundering concerns in this case.
There could be, right? Because your hedge fund owner, if he's using his personal account and getting deposits from multiple parties, that is a high risk category, right? That is a high risk criteria because you're receiving funds from multiple third parties, and he would have ideally disclosed that he's a hedge fund owner, so he's getting multiple funds. So how would the bank have control of the funds that are coming through to a personal account specifically? Because if it's an entity, then entity level controls can be checked. Their level of due diligence at an entity level can be checked, but how can you check that at an individual level?
Right.
So that's just my view. My personal view is it coming through an individual account is suspicious.
Thanks.
Okay, no worries. Any more questions before we move on to? That's actually a good question, right? Because that's a practical aspect of this, right? And there are so many cases that I wish I can discuss, but I can't because obviously these are confidential. But if you are working in a compliance function and an investigation function specifically, you will see a lot of cases. Either it's business misuse, evading taxes, and even in certain instances, point blank corruption as well, right? So it's a good question. Anyone else? Any questions before we move on to the questions? Any volunteers to read through the question? Okay, let me share the slide first. Can you see the slide?
Yes, sir, you can see.
Okay. All right. Answer is B. Rasik has already answered. So, okay. Anyone else? I didn't even read the question, but it's a straightforward question. Yep. The correct answer is B, right? FATF. The intergovernmental body that sets standards of to combat money laundering and terrorist financing is FATF. And please read through FATF responsibilities. There's always going to be a question around FATF. What is the NCA? NCA is the National Crime Agency. FCA is the Financial Conduct Authority. And ASB is the Accounting Standard Board. So these are all UK UK bodies. Moving on to the next question. Which of the following is the best example of a fraud offense? I won't read through, you can see in the slide. Okay, anyone the answer is this? Yes, the correct answer is D. So an investment operation that pays returns to investors from their own money or money that by subsequent investors, what is that called?
Ponzi scheme.
That's correct. And an offering of overvalued of, if not worthless securities through means of intensive selling, what is that called? Remember, we covered something called boiler room scams. And third is actually attempt to disguise is actually money laundering, right? So moving on to the next question. Quick one, quick and easy one. Okay. The answer is what's the correct answer? Yep, correct answer is B. Money laundering. Question 4. Which of the following is considered a fraudulent act? That's correct. So if you are omitting material facts, that is considered as fraudulent. A firm's money laundering and terrorist financing risk assessment procedure should be what's the correct answer? So the correct answer is reviewed at least annually, right? Not revised, not reassessed, not rewritten. It's reviewed at least annually. And there could be reviews in between if there is a regulatory change. But if there is no change and the status quo remain, at least it needs to be reviewed on an annual basis. The next question. Financial Action Task Force recommendation suggests which type of the following approach to anti-money laundering and combating of financing of terrorism. We discussed this on multiple occasions. So C is the correct answer. It's risk-based, right? So it's like a straightforward one. Question 7. An employee files an internal report regarding a suspicion to MLRO. The MLRO considers the report and decides to take no action. What happens next? C, right? MLRO will record the event and reasons for not sending the suspicious activity. Employee should never call the client and apologize. There is no involvement of the client when you submit a suspicious or unusual activity. Moving on to the next question. An employee reports a suspicion to the MLRO. Which of the following best describes what happens next? Sorry, what's the answer? I'm not getting an answer. A, 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 A. A is unfortunately the popular answer, but it's not the correct answer. So when an employee reports a suspicion, employee doesn't need to investigate. Employee's responsibility is to report the suspicion, right? Investigation is a specialized team which is under the MLRO, right? So one employee's responsibility is to report, and employee has no further responsibility to pursue the suspicion under the law. Their responsibility is to report, and it is the MLRO's responsibility to have a team for investigate, and then report to the law enforcement or not. Okay. Question 9. Which of the following would constitute fraud if performed and not disclosed by the investment advisor? So the correct answer is answer B, right? Acting as an agent of the brokerage firm that executes the trade that he recommends and receiving commission on them as a result. So something of this nature needs to be disclosed to the client prior to the deal being executed. Moving on to the next question. Mutual legal assistance between different legal authorities may be conditional on dual criminality. If this is the case, which of the following is false? Bit of a tricky one, take some time, it's okay. No answers coming in. So this is a bit of a tricky one. So the correct answer is answer C, right? Mutual legal assistance can only be declined on the grounds of bank secrecy. If you have mutual legal assistance, then it is not, you cannot decline mutual legal assistance for criminal matters within scope on the grounds of bank secrecy. Question 11. In order to minimize its money laundering risk, a firm should any answers for this one? So the correct answer to this is answer B. Unfortunately, that's a model answer, and basically what it means is um, it doesn't mean that it's not the nature of, it's not the individual suspicion activity that gets reported to the directors. It is the themes. So basically, if you look at all the suspicious activity reported to the regulator, you can identify what are the themes. Is it fraudulent activity? If it's money laundering, if it's bribery and corruption, those themes get reported to the directors and senior managers on an annual basis. Next question, which of the following predicate offenses involve the misuse of power? We spoke about it today. Quite relevant to Sri Lanka, at least as far as the Transparency International TICPI index is concerned. Yeah, I guess that everyone is getting it right. Okay, so D is the correct answer. Moving on to the next question. What is the rationale behind sanction screening? Yes, A is the correct answer, right? Firms should have process in place to identify those in the sanctions list. Next question. Financial Action Task Force on Money Laundering focuses on three principal areas. Which of the following identifies these three areas? Yep, the correct answer is B, 14, because FATF doesn't impose monetary penalties. However, they evaluate the effectiveness of the implemented standards, identify money laundering, trade finance methods and trends, and they publish papers and setting standards internationally for governments to follow. Moving on to the next question. Okay, I'm not going to read through straightforward question. Correct answer is C, an employee. Next question. An employee of an authorized firm suspects that deposits being made by a client are suspicious. Which of the following would allow the employee to distinguish funds being deposited for terrorist activities from those deposited for money laundering? Lot of you have answered the question. Answer is D. So let's read the question again. Correct answer is A, right? An employee of an institution authorized firm suspects that deposits being made by a client are suspicious. Which of the following would allow the employee to distinguish funds being deposited for terrorist activities from deposits for money laundering, right? So deposit from legitimate source such as standing order could be for terrorist activity. If it's a deposit for large one-off payment, it's more money laundering. The remaining three are more money laundering, and the only defining criteria is a legitimate source. So if you are being asked to distinguish between money laundering and terrorist financing, that fact of having a legitimate source differentiates terrorism financing versus money laundering. Question 17. Which of the following clients could pose the most risk for financial crime to the firm? Yes, the correct answer is D. Question 18. In which of the following circumstances has an agent committed a fraudulent act? Getting the answer. The correct answer is C, right? So some of you answered D, because if you look at the answer C, an agent knowingly tells a customer that a markup was 25, right? So for a fraudulent act, the intention matters, and knowingly misleading the client is a fraudulent act. D is actually a poor judgment, right? Because without getting authorizations, you have gone ahead and completed a transaction. 19. So I guess this is not covered in the session, but okay, that's correct. 5 years, right? 5 years is the correct answer. This is again from UK perspective. Question 20. Which of the following statements about the World Bank is false? Okay, do we have an answer? Yep, we've got the correct answer. Correct answer is D. Question 21. How often does FATF review its mission? This is FATF, right? FATF reviews its mission every 5 years. Again, something that we did not cover specifically on the slides, but it is in the text. 22. Which of the following behaviors may pose a high risk of financial crime to the firm? Yep, the correct answer is D, an offshore trust with complex and incomplete audit trail of investment activities, because that will disguise the beneficial owner, right? And as a result of it, people can launder funds when they don't know the origin, and people want to distance themselves from the money source, right? So that's why beneficial ownership is really critical. Next question is one. Correct answer is C. You've got the correct answer. All right. Moving on to the next question. Should be an easy one. Money that is proceeds of crime is placed on deposit in the UK. It is then transferred overseas into an offshore bank. Which stage of money laundering does this transfer represent? That's correct. Deposit is placement, transfer is layering. Next question. The auditor software company make the following comments. Comment 1. The accounting policies selected are inappropriate. Comment 2. The application of the selected accounting policies appropriate. Comment 3. The disclosure in the financial statements are inadequate. Which of the following is true? Okay, what's the answer? Answer D, because all these comments show a clear misstatement of financial circumstances. Question 26. The MLRO is an officer of the firm with the characteristics. Yep, answer D, authority and sufficient independence within the firm to carry out the duty. Who is responsible for the identification and the management of risk to financial crime within a firm? Okay, what's the correct answer? Correct answer is B, senior management, who is responsible for identification and management of risk. Financial crime management and identification of risk is the senior management responsibility. Moving on to the next question. Question 28. An investor has bought a credit default swap on a bond. On making a claim on the CDS, the investor discovers that the CDS provider is unable to pay. What risk has the investor suffered? That's correct. The correct answer is counterparty risk. Moving on to question 29. An effective way of mitigating the risk of unreliable market valuations of securities caused by market abuse or misstatement is so an effective way of mitigating the risk of unreliable market valuation of securities caused by market abuse and misstatement is what's the answer? Anyone else? Not getting the answers. C. Yep, C is the correct answer because when you have an effective transaction reporting regime, that in that way there is a fear factor around market abuse being created in the market, right? Then at least that acts as a preventive control. Question 30. Depositing small amounts of cash at multiple bank branches would take place at the place at the stage of money laundering. What is this stage? Yep, A is the correct answer. Placement straightforward. Which of the following drivers an international approach to combating money laundering? Again, I guess everyone will get this right. Yep, correct answer is D, FATF. How are the IMF topical trust funds to finance technical assistance in AML and CFT funded? Again, we didn't discuss this, but it's in the textbook. Okay. What's the answer? So since I am not getting an answer, I'll give you the correct answer. Correct answer is answer C, where member states have voluntarily committed to a set amount over 5 years. So that's the correct answer. Moving on to the next question, in order to reduce the exposure to financial crime, an individual can. All right, the correct answer is answer C. When disposing of financial statements and bank statements, use a shredder, right? Everything else is actually doesn't reduce your exposure to financial crime. Question 34. Under the AML and counterterrorism guidance, which of the following would identify a politically exposed person? Yep, correct answer is A. We spoke about this. They are more vulnerable to corruption because of their position and they have access to public funds. Question 35. Graham accepts regular deposits from the director of a small overseas company. Which of the stages of money laundering could Graham find himself under suspicion of money laundering regulations? What's the answer? Getting different answers. B, A, C. The correct answer is D, placement, right? So the moment you see accepts deposits to an account, it's more often than not is placement. 36, which of the following structures pay returns to separate investors? Not from any actual profit earned by the organization, but from their own money or money paid by subsequent investors. Again, we spoke about this. It should be easy one. Correct. It's a Ponzi scheme, right? And we've come to our final question. Which of the following is true of the observation below? The firm uses fuzzy matching on its screening software. The employees are not fully aware of the responsibilities of the MLRO. The employees know their personal liability in respect of money laundering. We have A as the answer. A is 1 and 2 show poor systems and controls. Firm uses fuzzy matching on screening software is actually a good control. It's not a poor control, so A is not the answer. Yep, the correct answer is B. All right, so that basically is the end of our question. So just ask yourself how comfortable you were answering these questions. If you are relatively comfortable, I guess you're making good progress. If you were not comfortable, then obviously I'll recommend you to read through the text, go through the slides and be comfortable. And I would assume the exam questions are going to be really relatively tougher than these questions. These are all practice questions. So I expect the exam questions to be tougher than this. All right, so that actually concludes my session. And I will have a revision session later on. I don't know the timing, probably September or so. I'll just wait for the timing for that. But that's the wrap up of my 2 sessions, compliance function and managing financial crime risk. Any questions, any thoughts? Okay, I'll take that as a no. And Himali, any other update you have to provide them on the next sessions?
Yes, sir.
Any update on the next sessions and when it will be?
Coming Saturday, we are planning. I have to check with Mr. Prasanna, sir.
Okay. All right. So Himali will update you on the next session and the dates. So good luck with the rest of the sessions, and also good luck with the program. And I'll catch up with you soon with the revision somewhere in September. Okay. Thank you.
Thank you, Shen.
Thank
Thank
you.
you.
sir.
Thank you, Shen.
Thank you.